Most couples spend their working years planning for a retirement together. But what happens if one spouse passes away first? It's not an easy question to ask, but it's one of the most important because the financial impact can be just as devastating as the emotional loss. CPP and OAS benefits can reduce or even be lost entirely. Company pension plans may drop significantly depending upon the survivor option you chose years earlier, and the surviving spouse could face higher taxes at the very moment household income drops. For many Canadians, this combination creates what we call the survivor's penalty, where the surviving spouse is left with less overall income and a higher tax burden. The good news, with the right planning, you can protect your family from this risk and ensure the surviving spouse has the income they need to carry on. Today, I'll show you how retirement income changes after one spouse passes and the steps you can take now to prepare. Hi, I'm Stefano Francesca, Certified Financial Planner Professional at Next Step Wealth Management with IPC Securities Corporation. If you find this helpful, don't forget to like, comment, and subscribe. It really helps more Canadians see this. Firstly, CPP and OAS can change significantly. Many couples assume that when one spouse passes away, their government benefits will simply continue at the same level. Unfortunately, that's not how it works. For the CPP retirement pension, well, firstly, there is a one-time $2,500 death benefit payment, which is taxable to the estate or the beneficiary made on behalf of the contributor. Then, the income benefit for the surviving spouse depends whether or not you are already receiving CPP income. If you're not collecting CPP, then your age matters. If you are 65 or older, you will receive 60% of the contributor's retirement pension. If you're under age 65, then you'll receive a flat rate portion and 37% of the contributor's retirement pension. If you are already receiving CPP income, then the combined CPP benefit for the survivor is capped at the maximum CPP amount for a single person. So if you're already receiving close to or full CPP retirement income, you may not get much, if anything, from your spouse's CPP after they pass. If you're not already taking CPP and the survivor benefit becomes available, then you might consider deferring your CPP for as long as possible in order to collect the survivor payment. For old age security, there is no survivor benefit at all. When one spouse passes, their OAS payments stop completely. So here's an example. If each person in a couple was receiving $14,200 per year from CPP and about $8,800 per year from old age security, that's $23,000 per spouse or $46,000 combined. After one spouse passes, the survivor will see their total CPP drop to the maximum cap for one individual, and the OAS reduced to the $8,800 for an individual, leaving them with closer to $26,000 rather than the $46,000 they were accustomed to. That's more than a 40% drop in government income, even though household expenses don't drop nearly as much. Secondly, company pensions may be reduced. If one or both spouses have a defined benefit pension from work, it's crucial to understand what survivor benefits can be or were chosen at retirement. Here's how it works. At retirement, pensioners are usually required to select a joint and survivor option that determines how much of the pension continues for the surviving spouse. A 100% joint survivor benefit means that the full pension continues. This usually provides a lower pension income for the pensioner, but income stability at the same level for the survivor. You also usually have options to provide less to the surviving spouse, such as a 50% or 66 2/3% option. This usually provides more income to the pensioner until their passing, but then significantly less for their spouse. The trade-off is that selecting a higher survivor benefit usually reduces the monthly pension amount while both spouses are alive. And of course, if both spouses pass away after the guarantee period, the value of the entire pension is lost for the estate. This decision, often made years earlier, can have a huge impact on the surviving spouse's ability to maintain their lifestyle. Thirdly, tax changes for the surviving spouse. Here's something that surprises many Canadians. Even though household income drops when one spouse passes, the surviving spouse may end up paying more tax. Why? Because they move away from all the benefits of filing tax returns as a couple to filing as a single, which is less favorable. Here's what happens. The surviving spouse no longer benefits from income splitting, which helps keep taxes low for couples because you're taking income into lower average tax brackets. You lose the ability to transfer unused tax credits, as well as to effectively combine credits and expenses. With all income now now reported to one return, they may be pushed into a higher tax bracket. This can also increase the risk of triggering the OAS clawback, where some or all of the survivor's old age security benefit is taken away. This is sometimes called the survivor's penalty, and it can catch even well-prepared retirees off guard. Fourthly, TFSA and RRSP RRIF transfers. The way your accounts are structured also plays a big role in what happens after one spouse passes. For TFSAs, if the surviving spouse is named as a successor holder, they can take over the TFSA tax-free and keep all of its tax advantages. For RSPs and RRIFs, these accounts can roll over tax-deferred to the surviving spouse if they are named as the beneficiary or successor annuitant. This spousal rollover provision avoids having the full value of the account taxed as income on the deceased person's final return. Planning ahead to protect the surviving spouse. So what can you do today to protect your spouse if the unthinkable happens? Here are some practical options. Review pension options carefully. If you're approaching retirement, consider the long-term impact of choosing lower survivor benefits in exchange for a higher pension today. If you're healthy, you should look at our pension maximization strategy that can provide comparable retirement benefits and preserve the value of the pension and its income for the surviving spouse as well as for the estate. Commutation of pension options. In many cases, especially public service pensions, there is some flexibility prior to age 55 to commute the value of your pension. Some private pensions also allow this option all the way until your retirement date. This allows you to remove the value of your pension so that it becomes your money rather than that of the pension. For many of you, your defined benefit pension plan can be both a blessing and a curse. A blessing because someone else is responsible for providing you and your spouse a lifetime income. A curse because it's hundreds of thousands of dollars trapped in a plan that will never be part of your estate and that your children will never see. By commuting your pension, you forego the guaranteed lifetime income from the pension, but what you get in return is all the assets, significant income flexibility, and wealth to transfer to your beneficiaries. Careful planning with appropriate assumptions needs to be made surrounding this choice. Planning around your CPP. Understand how the CPP benefit works, not just for yourself, but for your surviving spouse. For example, if you're not already taking CPP and the survivor benefit becomes available, then you might consider deferring your CPP for as long as possible in order to collect the survivor payment. Coordinate withdrawals smartly. Work with a planner to balance withdrawals from RSPs, TFSAs, and non-registered accounts. This can help reduce the surviving spouse's future tax burden and avoid triggering OAS clawback. This may mean more of a focus on registered withdrawals first and a CPP deferral strategy to accommodate the valuable income splitting opportunities available to couples. Consider life insurance as a bridge. A permanent life insurance policy can provide the survivor with a tax-free lump sum to replace the lost income or the total future value of an income benefit that could be lost. Update your beneficiaries and estate plan. Make sure all of your accounts, your TFSAs, RSPs, RRIFs, pensions, have the correct beneficiaries and your will is up to date and reflects your wishes. And while you're at it, make sure to complete and update your personal directives, as we call it here in Alberta, for healthcare, as well as your power of attorney for financial matters. By planning ahead, you can make sure your spouse has the financial stability to focus on what really matters during a very difficult time. Losing a spouse is one of life's most difficult challenges. And while we can never fully prepare for the emotional side of it, we can prepare for the financial impact. The reality is that government benefits like CPP and OAS often drop when one spouse passes. Company pensions may be reduced depending upon the survivor benefit chosen, and the surviving spouse may face higher taxes at the very moment household income decreases. The bright side is that with the right planning, you can prepare and give your spouse the confidence that they'll be okay no matter what life brings. This is one of the most important conversations I have with couples nearing retirement. It's all about protecting the people you love and ensuring your retirement plan works for both of you. If you're a Canadian retiree or within 15 years of retirement and you want a personalized strategy to protect your income and your spouse, click the link in the description to book a free consultation. Our Next Step Wealth Management service includes reviews of your pensions, government benefits, and withdrawal strategies. We'll show you how to build a plan that keeps your spouse financially secure, even in the face of life's uncertainties. The earlier you plan, the more options you'll have. Let's take the next step.